As of Friday, January 30th, 2026 at 11:15 a.m. EST, Bitfarms Ltd. is trading at $3.22 CAD on the Toronto Stock Exchange, reflecting an intraday drop of 3.01%. The stock has faced a volatile morning, hitting an early high of $3.33 before sliding toward a low of $3.18 as sell-side pressure intensified. While the immediate reaction might suggest a routine pullback, there is a much deeper story playing out beneath the surface of the ticker. The common market narrative right now is that Bitfarms is just another miner riding the waves of Bitcoin's price action, but the reality is that the company is currently in the middle of a massive structural pivot toward high-performance computing and artificial intelligence infrastructure. This shift is creating a significant gap between what retail investors expect, a simple crypto proxy, and the reality of a company aggressively diversifying its power assets to survive in a post-halving environment. This is no longer just about hashing, it is about who controls the most valuable commodity in the digital world: energized power capacity. Institutional activity around Bitfarms has remained surprisingly robust despite the recent downward trend in share price. Over the last several months, we have seen major players like VanEck and the Schwab Crypto Thematic ETF maintain or even increase their presence in the stock. This institutional backing suggests that while the retail crowd might be panicking over daily price swings, the smart money is looking at the long-term utility of the 955 megawatts of potential power capacity Bitfarms has secured. The reality is that Bitfarms is transitioning from a Canadian-centric mining firm to a U.S.-heavy infrastructure play. By exiting its LATAM operations and focusing on sites like Panther Creek and Scrubgrass in the United States, they are positioning themselves in jurisdictions with much more stable regulatory frameworks and better access to capital markets. This geographical shift is critical because it moves the company away from the high-risk frontier market narrative and toward a utility-style valuation model that big money managers find far more palatable. Looking at the trading volume, we are seeing about 1.16 million shares move today, which is slightly below the historical average, but high enough to indicate that the current sell-off has some conviction behind it. The recent downgrade by KBW earlier this week, citing AI execution risks, has certainly weighed on sentiment. This is the classic expectation versus reality tension. The market expected a seamless transition from mining Bitcoin to hosting AI workloads, but the reality is that building out data centers for H100 and B200 chips requires a completely different level of cooling and electrical engineering than a standard mining rig setup. Investors who thought Bitfarms could simply flip a switch and become an AI powerhouse are now facing the reality of a multi-quarter capital expenditure cycle. This is why we are seeing the stock trade at a significant discount to its 52-week high of $9.27. The company's recent financial moves highlight a clear desire for liquidity. Closing a $500 million offering of convertible senior notes late last year was a bold move that signaled two things. First, that Bitfarms is serious about its expansion plans, and second, that they are willing to dilute existing shareholders to ensure they don't get left behind in the infrastructure race. If you are an investor using a Fidelity brokerage or checking your positions on the Robinhood app, you've likely noticed that the entire mining sector is being revalued based on power, not just Bitcoin production. This is where Bitfarms stands out. With over 60% of its operations now located in the U.S., it is no longer just a Canada stock, it is a global energy player. However, the market is currently punishing Bitfarms for the uncertainty of their AI pivot. The expectation was that the Stronghold acquisition would immediately boost the bottom line, but the reality is that integrating those assets and retiring Stronghold's old debt has created a temporary drag on earnings, with the next report expected in late March to show a year-over-year decrease in EPS. Despite the short-term pain, the business model remains fundamentally sound for those who understand the value of energized land. Bitfarms operates integrated data centers that validate transactions on the blockchain, but their real product is their ability to secure and manage massive amounts of electricity. In Quebec, they even provide electrician services to commercial customers, showing a level of vertical integration that most of their competitors lack. This self-investing in their own technical capabilities is a hedge against the rising costs of third-party hosting. When you look at the landscape of online investing, you often see people comparing Bitfarms to Nvidia stock or Apple stock, which is fundamentally the wrong comparison. Bitfarms is a landlord of the digital age. They own the pipes that the digital economy flows through. The tension here is that the market still views them as a high-beta Bitcoin play, while the company is trying to rebrand as a stable infrastructure provider. Comment below how many shares of Bitfarms you currently hold and whether you think the pivot to AI is a smart move or a distraction from their core mining mission. We have to talk about the halving effect. Traditionally, the expectation is that Bitcoin miners will struggle after the block reward is cut. The reality for Bitfarms is that they have been preparing for this for years by upgrading to next-gen miners like the S21 Pro Bitmain units. These machines are significantly more efficient, allowing Bitfarms to maintain a competitive hash rate even as the difficulty increases. However, the market often ignores these technical upgrades in favor of the headline price of Bitcoin. This creates a disconnect where the company's intelligent portfolio of hardware is actually performing better than the stock price would suggest. If you're using a SoFi trading platform or interactive brokers trading tools, you can see that the short interest in BITF has actually decreased recently, suggesting that the bears are starting to lose confidence in the downward trend. The volatility we see today is also a reflection of broader macroeconomic pressures. As interest rates stay higher for longer, the cost of capital for capital-intensive businesses like Bitfarms remains a concern. This is why their move to secure $500 million through convertible notes was so pivotal, because it gave them the dry powder needed to execute their strategy without being at the mercy of traditional bank lending. When people look for investment help or browse investing sites, they often miss these nuanced capital structure details. They see a 3% drop and assume something is wrong with the company, when in reality it might just be the market digesting the long-term implications of their debt structure. For those navigating their own individual brokerage accounts, it's important to realize that Bitfarms is currently a battleground stock. On one side, you have the Bitcoin maximalists who want the company to focus solely on mining. On the other, you have the tech-focused investors who see the massive opportunity in AI hosting. The reality is that Bitfarms is trying to do both, and that is where the risk lies. If they spread themselves too thin, they could fail at both, but if they successfully leverage their 900 megawatt power pipeline, they could become one of the most important infrastructure companies of the next decade. This is the ultimate expectation versus reality test. The market expects a mining company. Bitfarms is building an energy empire. Looking at the technical indicators, the stock is currently testing some key support levels. If it fails to hold the $3.15 to $3.20 CAD range, we could see a further slide toward the $2.80 mark. However, the institutional buy-the-dip mentality has historically kicked in at these levels. If you are using Fidelity ETFs or managed portfolios, you might find that you already have exposure to this sector through thematic funds. The reality of the modern market is that stocks like BITF are increasingly being bought by algorithms and ETFs rather than just individual retail traders. This leads to more coordinated moves and higher correlations with the broader tech sector, specifically names like Nvidia stock. When Nvidia has a bad day, the market often sells off anything related to data centers, including Bitfarms, regardless of the company's specific fundamentals. The company's recent financial moves highlight a clear desire for liquidity. Closing a $500 million offering of convertible senior notes late last year was a bold move that signaled two things. First, that Bitfarms is serious about its expansion plans, and second, that they are willing to dilute existing shareholders to ensure they don't get left behind in the infrastructure race. If you are an investor using a Fidelity brokerage or checking your positions on the Robinhood app, you've likely noticed that the entire mining sector is being revalued based on power, not just Bitcoin production. This is where Bitfarms stands out. With over 60% of its operations now located in the US, it is no longer just a Canada stock, it is a global energy player. However, the market is currently punishing Bitfarms for the uncertainty of their AI pivot. The expectation was that the Stronghold acquisition would immediately boost the bottom line, but the reality is that integrating those assets and retiring Stronghold's old debt has created a temporary drag on earnings, with the next report expected in late March to show a year-over-year decrease in EPS. Despite the short-term pain, the business model remains fundamentally sound for those who understand the value of energized land. Bitfarms operates integrated data centers that validate transactions on the blockchain, but their real product is their ability to secure and manage massive amounts of electricity. In Quebec, they even provide electrician services to